Scott, I think we're still seeing the repercussions of that April 10th crypto deleveraging event. It was the biggest deleveraging event ever. And there are still, I think, some market makers that have some balance sheet issues that are trying to raise capital. So I think that this is leading to a market that is kind of raised. Every time we get a bit of a rally, there's some capital trying to be raised. And I think that's what's suppressing crypto for now. That's, of course, going to end soon, but I think that's led to why crypto has underperformed equities since October 10th.
If you are staring at a sea of red in your crypto portfolio, Tom Lee is telling you the story starts with mechanics, not magic. He frames the entire drawdown as the aftershock of one enormous forced unwind. When balance sheets are stressed, every bounce becomes an excuse to dump into strength. That is why rallies feel like they die on contact. But the key phrase in his view is that this pressure is going to end soon, which is exactly where the idea of a violent reversal begins.
Well, it's never fun to see markets wobble and then stocks that are quite popular like AI and the quantums and nuclear come down so hard. But it is consistent with the idea that, we were up 6 months through October, so the market's overbought. We expected 2 weeks of consolidation, which is what we're getting. And then, of course, as you know, there's hawkish Fed talk, so there's a bit of a tantrum the market's having. But between now and year end, we still have really good seasonals. The earnings have been good. Sentiment has flipped negative, Scott, as you could tell. I mean, the AAI went to negative 17.5. So I'd say the risk reward is still really good for equities into year end. And yeah, I think the S&P will be over 7,000 by the end of the year. In fact, maybe over 7,000 by the end of the month.
Here, Lee widens the lens. Crypto is not falling in isolation. It is part of a broader shakeout in the same growth and risk complex that includes AI, nuclear, and other high beta names. He describes a classic reset after a 6-month surge, layered on top of nervous chatter from the Fed. Yet even with that wobble, he thinks the risk-reward into year-end is still really good, and even floats S&P 7,000 in a very short time frame. If he is that bullish on equities into a consolidation, it implies that once the forced selling in crypto burns off, the catch-up move could be sharp.
I think we should expect from time to time profit taking because tech has been a leader for the last decade, and it is overbought. So I think it is going to be from time to time going to show extended weakness. But to me, the underlying story driving technology, which is the productivity miracle coming from AI, is still intact. Mary Erdos even talked about this earlier this week from JP Morgan that there's been a payoff in spending, and Lisa Su at AMD as well as noting that productivity lift is the reason AI spending is rising. That's actually still a tailwind for tech stocks. And names like NVIDIA are still reasonably priced. I mean, NVIDIA at 28 times forward earnings is still less expensive than buying Walmart or Costco. Costco is almost 50 times forward earnings.
This is where his equity and crypto views start to rhyme. Lee is not denying that leaders can get stretched. He is saying that weakness in them is often just the price of prior strength, not the end of the story. The productivity miracle of AI, in his words, is still there beneath the volatility. That same logic can apply to digital assets that live on the edge of technological change. If the structural drivers are intact, a shakeout that looks scary on a chart can actually load the spring for an aggressive move higher once the marginal seller is gone.
I don't know if we'll get more of it, but investors should expect more of it. I mean, if you look even at the late 90s, during the heyday of the dot-com bubble, 96 double-digit sell-off, 97 double-digit sell-off in the NASDAQ, 98 big sell-off on LTCM and some other weakness, and then 99 even big sell-off in the NASDAQ. So double-digit sell-offs even in bull markets driven by new technologies and exciting new technologies are really common. And this one, is just par for the course, I think, amid a broader bull market. So as long as the technicals and the underlying trend isn't too damaged, I think it is a dip you can buy. But I think investors should always expect a little bit more weakness. We've been on a tremendous run off the April lows. That kind of momentum can't sustain forever.
Ross brings historical context that fits perfectly with Lee's framework. In the late 90s, some of the biggest long-term winners suffered brutal, repeated drawdowns. The pattern did not invalidate the secular bull market, it expressed it. When new technology leads the market, volatility is the toll you pay on the road to outsized gains. Applied to crypto, that mental model suggests that a double-digit flush, even one that feels extreme, can coexist with a longer trend that is very much alive.
Yeah, well, I think it is helpful to think about where we are in the cycle. I know the Fed is a little hesitant the reason to cut in December, but the reason they're hesitant to cut is the economy is actually pretty healthy, and they just don't have a clear contour of how quickly inflation's cooling. That's a very good backdrop for corporate earnings, actually even corporate earnings to actually start to spread. So if the Fed gives us some guidance and visibility about, path forward, I do think business confidence picks up. That means that ISM starts to recover, and it is a broadening trade. So I would agree with the other speaker that, I like tech structurally because of AI spending, but there's still plenty of room for the small caps to work, which have really taken it in the gut as the Fed's sounded hawkish, and the banks. And so I'd be in sort of favor of a broadening trade as well. But I still like tech. And as you know, the AI trade comes under question every few months. There's always a big pullback, but for the last 5 years, investors have had to buy that pullback.
Here, Lee explains why he sees this period as a mid-cycle scare, not a late-cycle crack. A healthy economy with earnings that can start to spread is exactly the backdrop in which liquidity hunts for returns in neglected corners of the market. His phrase, broadening trade, is key. It hints at a phase where leadership widens beyond a small handful of megacaps. If investors are ultimately trained to buy every big AI pullback, it is not a stretch to imagine that same instinct extending to beaten up crypto once macro visibility improves and the deleveraging hangover fades.
No cut in December. Let's just say that that's now the base case. And AI remains volatile. The broadening trade looked pretty good at times this week, to where we were thinking of, okay, maybe we're going to get an everything rally. You think that's possible?
Yeah. I mean, I think one reason the Fed is backpedaling on a cut in December is not because they have more confidence that inflation is strengthening. In fact, many of them said they just don't know, but in general, they agree it's probably not. I think that there are signs that the labor market is maybe stabilizing. So you actually have a Fed waffling for the right reason, which is, look, if the employment market's holding up, the Fed doesn't have to cut. That's still a good environment for equities. I'm not trying to spin it, but it's not a bad reason if the Fed is starting to have second thoughts.
Even when the Fed hesitates, Lee treats that hesitation as coming from strength, not fear. A stabilizing labor market and okay growth mean the foundation under risk assets is firmer than headlines suggest. And everything rally becomes a real possibility if that backdrop persists and investors stop worrying about an immediate hard landing. In that kind of environment, crypto can move from being the punching bag of forced sellers to the high beta expression that reacts the fastest once risk appetite returns.
Sure. And I think it's incredibly healthy that as AI is pulling back, we're getting some nascent leadership from things like energy. Healthcare has had a tremendous month thus far after being really beaten up for a couple of years. Financials, big banks, both in the US and globally, have held up solidly. So, obviously the headline indexes are going to be weighed if big tech sells off. But I think it's incredibly healthy both on the earnings front and on the price front that you're seeing some breadth. Especially at a time when the question about the broader economy outside of AI is how healthy is it, right? So this is a really good sign to me, and I'm happy to take a little bit of gains from tech and rotate into some nascent leadership there in other sectors.
This idea of nascent leadership adds another layer. When investors rotate into areas like energy, healthcare, and financials, they are not abandoning risk, they are diversifying it. Crypto often thrives when breadth improves, rather than when only one narrow trade works. If the market begins to trust that the broader economy is okay, money can explore more speculative edges. Combine that with forced sellers stepping aside in digital assets, and you have the ingredients for an up move that feels sudden and violent. At this point, we have heard Lee describe a mechanical deleveraging, a healthy but overbought market going through consolidation, an AI-driven productivity boom, and a macro backdrop that still supports earnings and a broadening trade. We have also heard the reminder that double-digit drawdowns are common, even inside powerful bull markets. Put together, the message is not that pain is imaginary, it is that pain can coexist with setups that favor aggressive upside once the pressure valve releases. That is the core logic behind the idea that the crypto drop is setting up to reverse hard rather than drift sideways forever.
I think from a market's perspective and from the economy's perspective, we know that high rates are actually causing pressure on the housing market. That is, something that I think the Fed actually has can actually have some impact on. So I do think it makes sense for the Fed to cut.
If Lee is right, and the next big move from the Fed is toward easing rather than more tightening, that is rocket fuel for assets that are most sensitive to liquidity, including crypto. So now it comes back to you. After hearing his view on deleveraging, seasonals, AI, breadth, and the path of rates, do you think this crypto drop is just noise inside a bigger bull market, or are you still worried that something more serious has changed for good?